In today's strategy, we're going to be focusing on the intermediate term trader. These are traders who would not want to get in and out of the market every single day, but to hold positions for a longer period of time. We're going to be looking at the euro versus the dollar, which we showed you in the first example of short-term trading. And we're going to be using the monthly for trend, which is right here, and the weekly for timing. A little bit different from our first strategy, which was the weekly for trend and the daily for timing. So let's just click once here and you'll see our monthly goes in right here. Then we're going all the way back to September 7th because that's where the first, you don't get too many signals using the monthly. So here's September 7th, and you can see from this period on we had 1, 2, 3 signals. Now the signals indicates that the major trend is up. So in this case, when the market goes up, it means the euro is going higher against the dollar, and conversely when it goes down it means the euro is going lower against the dollar. So as you can see, this is a pretty nice indicator. Then we had a sell signal, a reversal trend down. It lasted for a very brief period of time, and then we had a trend up, and then of course that's lasted for quite some time because that signal was on the June 6th of 2013. So let's put our weeklies in and you'll see exactly how this works. So you just go up to the triangle box right here, click once, and you can see quite a number of green and red trade triangles weekly. And as I say, the markets have been, this has been rather choppy, but we still made a profit on this longer term, and I'll show you how that works. So the first position was taken right here. This is on the 7th of September 2012. The market moves up very nicely, and then we have a signal here at 128.25, and that produced a profit of 98 pips. A little disappointed we didn't get out at the top, but to be honest with you, you never get out at the top. The next signal came here because remember, we don't go short, we only go with the direction of the major trend, which is the monthly. So the next signal was right here, and this is a buy on 11/26. And that was a 129.86. The market moved up nicely as we thought it would, and we exited this position on February 20th at 133.11. Now we will have all these results at the back, and I won't go through every single trade, but you'll get the idea of how to use this strategy. So that produced a nice profit of 325 pips on that trade. Now remember, we're out of the market now. The market drops dramatically. Then we get a monthly reversal at 128.77 on the 19th of March, indicating the market should go down. Well, it did go down, but briefly, and then it reversed, and that was a signal for us to get out of the market at 130.77, and that produced a loss of 200 pips. Disappointing, but that's just the way it goes, and you have to be disciplined to follow this program. So the market moves up. Remember, the trend is down. Get back short here on May 10th at 129.57. The market moves down. We cover that position at 130.60. That produced another loss of 103 pips. So after we started out so well, we've had a couple of losses, and then we get a monthly reversal here. Now this is a monthly reversal on June 6th at 132.32. Market moves up dramatically, comes right back down. We get stopped out for another loss, and that was a loss of 245 pips, and that was on the 2nd. That's rather unusual. So anyway, we know the trend is up based on a monthly trade triangle. So we get long again here on the 22nd at 131.80. The market moves up. We're out at 132.10. I'm happy to say that produced a very small profit of 30 pips. Out again, we get back in at 133.92. The market moves up. We exit this position at 134.78, and that produces a profit of 86 pips. So we're on the sidelines again as the market moves down. We get back in here at 135.64 on the 26th of November. Market moves up. We're exit the position at 136.59. Nice little profit there of 91 pips. Market comes down. We get back in when the momentum turns around. We get long at 137.14, and the market closed on the 21st, which is what our time period, at 137.38, which is right around these periods right here, and that produced an open gain of 24 pips. Let's take a look at those results right now and go through trade by trade. Okay, here we are at the FX strategy for intermediate term traders results page. These are all the trades I showed you on the chart with the results. Now, there has been something happening in the Forex markets that probably most people haven't been aware of or haven't even spoken about, and that is the contraction between the ranges in the Euro-USD cross. And what I mean by that is that it's getting narrower and narrower. And let me give you a concrete example of how that works. In 2007, the range between the high and the low was 2,000 pips. In 2008, it was 3,600 pips, and so on and so forth. In 2012, which is what we're showing you, and 2013, the range dramatically narrowed. Over half. If you look at the averages, we lost over half the range in a very short period of time. So if you can make money in a market that's contracting like that, you can do very, very well. In fact, the years 2007 through 2011 were exceptional years in the Forex markets. Those years will come back. They always do. There's always some crisis somewhere that you can make money on. But the bottom line is you have to be disciplined and you have to follow a game plan. This particular market strategy, the intermediate term trader strategy, has done extremely well over the years. The results we're showing you today showed that you still made a net gain of 106 pips over this time period. You did not lose money, which is the important thing. So this is our intermediate term trader strategy. We'll be coming out with our next video, which is for our long-term FX strategy, which I think you'll enjoy, and that's showing some remarkable profits. So till then, thank you for stopping by. I hope you found this video educational and helpful to your own trading, and every success using our trade triangles.